Today I'm going to walk you all through how we think about investment strategies for our clients and how we help move from just growing wealth to using it with purpose, especially as they approach or enter retirement. So there's more than one way to invest, obviously, as you've seen in what we've been talking about. These are some popular investment strategies. You may have heard of some of these names. If we throw some out there like growth, moderate, conservative, total return, capital preservation, a lot of times people don't know exactly what they mean, but the main difference in each of these is the level of stock exposure and the type that drives risk and return expectations. So the key to picking a strategy is knowing what to expect from your portfolio and what you need so you can pick the correct strategy for you, regardless of what we end up calling it. So if we move on to the next slide, we can look at how we would maybe select your portfolio. So the way we manage risk is to control the dials and how much exposure is essentially in stocks versus more income-based items. So portfolios like the speculative that we saw earlier are on the far end of the risk scale where equity is over there to the right. Growth and total return might be in the middle with some growth in income exposure. And then conservative capital preservation, they're going to be toward the left with most like fixed exposure. So these are, think about CDs, bonds, things that we know are going to guarantee a fixed rate of return. So when we are aligning what is considered, a good fit for clients, we're working together with you to determine what your comfort level for risk is. And we know because of evidence-based investing, other things that Mark's talked about earlier, what a typical swing will look like from the high expected return to the lows, based on that composition that you have from one of these portfolios. So not only are we looking at what your comfort level is with the market, but also some other factors like how much growth do you actually need to have in order to achieve your target goals. Too much risk, which is over there on the right-hand side, may not be necessary, but too little risk. So if we go all the way down on that scale to the left can also be problematic. For example, the far end of this chart with equities will be stock market risk, which, everybody, of course, is focused on right now during times like this. And if the variability of returns feels like it's too much, if we can also achieve your goals by having less risk, then we'll likely step down on the scale toward that more conservative. But going to the other end of that spectrum, then back to fixed income, of course, there's risk there too. And it might feel comfortable to know, for example, that we can get, say 5% return on a CD, which is great, right? No loss of income. We're making a small return. In many cases like that, it's guaranteed where we have no loss of principal. But the risk not often seen here is, are we able to stay ahead of inflation? When that CD comes due, number one, will rates give us a similar rate of return at that time? And then number two, we could be underperforming our purchasing power and not really realizing that until it's too late. So regardless of whatever we call the portfolio, ultimately, we just need to match your risk comfort level with what you need as far as goal success and outcome.